Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. We would also greatly appreciate if you consider supporting us on Patreon, so please check the link in the description for more details. My name is Sava, and today we're discussing yet another test for market efficiency that can be used to determine if stock prices follow random walks. But unlike the previous tests we have discussed in previous videos, like runs test or variance ratio test, this one is quite a bit more flexible and can be much more easily translated into trading strategies that can be used to exploit the inefficiencies you discover and gain you potentially some abnormal profits. This test utilizes the logic of Markov chains. Markov chains are a very useful tool in mathematical statistics and probability theory that is crucial in interpreting and visualizing probability. The logic of the test is that you take some daily data or any period data on the returns of your financial instrument of choice, and in our case it is, as usual, the returns of S&P 500 index over a 5-year period from the start of 2015 all the way down to end of 2019. And to apply the Markov chains test for market efficiency, you have to separate those stock returns into states and calculate the probabilities of transition from one state into the other. What exactly are states? Well, it's perhaps the easiest to conceptualize states when considering the simplest case with two states. And here, Markov chains test can remind you of the runs test. Consider this. Let's separate our stock returns into stock returns above zero and below zero, and name those states 1 and 2 respectively. Then we can calculate the probability of the stock return moving from state 1 to state 1, so moving up after moving up in the previous day, and the probabilities of transition from states 1 to 2, 2 to 1, and 2 to 2. So respectively, what is the probability of the stock price going down after it went up, of it going up after it went down, or of it continuing going down after it went down in the previous day? But you don't need to stop there. You can consider more states than two. You can separate your stock return data into equal subsamples based on the value of the magnitude of the return, and calculate what are the probabilities of the stock return transitioning from one state into the other in the following day. So how to apply it mathematically? Well, first of all, we have to calculate the empirical distribution of stock returns, and it has to deal with ranks of our stock returns in the overall sample. So we can first of all just calculate the rank, and here it's the best to calculate average ranks. However, it doesn't really matter. You can also opt for equal ranks. The results would not differ much. And we just need to calculate the rank of a particular observation in the whole array of stock returns. And this array has to be locked because we don't want it to change observation to observation. And we need to rank our stock returns in the ascending order from lowest, the most negative, to highest, the most positive. So we input 1 over here. And then we have to divide it by the total number of observations we're having. And you can easily verify it using the count function, for example, that the total number of stock returns in our 5-year trading period is 1258. So this easy procedure will give us the empirical distribution function for the stock returns of S&P 500. And now, based on these values of the empirical distribution function, we can sort our stock returns into states. And here I'll consider 3 examples with 2, 3, and 4 states respectively. Here we need to apply some neat mathematical tricks using Excel formulas, but bear with me, it would be really intuitive when we get through it. To separate our stock returns into 2 states, we need to consider stock returns below and above the median. So we can just apply the round down function and apply it to our value of the empirical distribution, and we have to lock the column here because we will drag it around for different numbers of states and we don't want it to change in terms of the column and multiplied by the number of states. And here we have to lock the row because we want the column to change as we move to an example with a different number of states, but we don't want it to change when we move from observation to observation within one example with a particular number of states. And we need to round it down to the nearest integer, so the number of digits is 0, because we're not concerned with the decimal expansion, we're concerned just with the integer, because we want to separate them into states 1 and 2. And the final problem is that we have got an example when our value of the empirical distribution function is equal to 1, which is the highest value of our stock return throughout the period, the maximum. So we have to subtract 1 if our product of the empirical distribution function and the number of states is wholly divided by 1. So here, if mod, which is the remainder of whole division of the same expression, mod C3 times D2, which is the empirical distribution function times the number of states, divided by 1 is equal to 0, we have to subtract 1 and leave it as it is if it's not the case. And here we will get a value of the function that will give us 0 or 1 if we have 2 states, 0, 1 or 2 if we have 3 states, and 0, 1, 2 or 3 if we have 4 states, and so on and so forth if we were considering examples with even higher number of states. And finally we have to add 1 so that our state IDs are natural numbers, so starting with 1, not starting from 0. So that's just a technical complication here that is easily accounted for by just adding 1 to the formula. So we can enforce this formula, drag it across the total number of states, and bottom right click it all the way down for all of our observations. And we can see that this neat formula has allowed us to sort our stock returns into 2, 3 or 4 states respectively. For example, the stock return of 1.34 that occurred on the 16th of January 2015 is so high that it is, first of all, the 95th percentile of the empirical distribution, which can be considered quite high historically. And we can see that our procedure has sorted it into the second state in the example with 2 states, third and fourth in the examples with 3 and 4 states respectively. So always it classifies it into the state with the highest return. So bear this in mind. In our case, the higher the number of state, the higher is the return. That's what we will be interested in when formulating potential market-beating trading strategies. And for example, the other way around, on the 27th of January 2015, the return was minus 1.34%, which was approximately the 6th percentile of the empirical distribution function. And we can see that regardless of the number of states, it always sorts it into the first state. So the state that is characterized by the lowest returns, the most negative returns that have been observed during this observation period. So now we have to actually calculate the transition probabilities, or the number of realizations of a particular event, of a particular transition. So here we have already got some table templates set up. So for the case of 2 states, we will just need to calculate the number of occurrences when an observation of state 1 is followed by an observation of state 1, an observation of state 2 is followed by the observation of state 1, and so on and so forth. So basically, it calculates how likely it is that a particular transition occurs. So without further ado, we can just apply the count ifs function and count how many times we have got our observation of a particular state, and here we have to get all the way down except for one last observation, and we need to lock both the column and the row in its array. So we need to count how many times our initial observation falls within the first state, and here we need to lock the column but not the row. How often is it followed by the observation from the first state as well? So here we have to select the array starting from the second observation, because the first has already been taken, and get all the way down to the very end. And here we also have to lock it all, both columns and rows, and refer to the one at the top. And here we also need to lock the row, but not the column. So applying this quite bulky yet quite intuitive function, we can count how many times is a 1 followed by a 1. And dragging it across and down, we can see how frequent are those transitions. We can see that it's more likely that a 1 will be followed by 2, and it's more likely that the 2 will be followed by 1, all other things held equal. So we already can notice some inefficiency, some predictability, but how significant are these inefficiencies, these discrepancies? We would expect, if the market was perfectly efficient, that those two values and those two values would be equal, because it wouldn't matter what happened before in terms of what would happen tomorrow. So to compare this with some expected scenario that we would have expected if the market was perfectly efficient, we can calculate the expected occurrences of such transitions and apply the well-known Chi-squared test to calculate how significant is the deviation from the expected outcome. And we have already got a separate video that when we explain the logic and the application of the Chi-squared test, so here we'll cover it just briefly. To calculate the expected number of transitions in a particular row, that basically is a transition following a particular state that has been realized in the past, we can just calculate the average over all elements of a particular row. And given the fact that we will apply it for multiple examples with 2 states, 3 states, and 4 states, we can just calculate the average of this array with empty elements so that we could copy it across and not bother ourselves with typing the formula over and over again, given the fact that Excel recognizes empty cells as blanks and doesn't consider them towards the calculation of the average. And the only thing we need to do here is to lock the columns, but not the rows, obviously, and apply the formula and drag it across and down. So we can see that here we would have expected an observation of state 1 to be followed by 313 observations of both state 1 and 2, and it quite significantly deviated from the reality. But to formalize our hypothesis testing, we have to calculate the chi-squared statistic. And we can actually do it in one go here. We can just apply the sum function and sum the squared deviations of the observed values from the expected values, so this array minus that array squared, divided by the occurrence of the expected values over here, and that gives us our chi-squared stat. And we have to reinforce this formula using Shift-Control-Enter, as this formula deals with subtracting and dividing a bunch of matrices. So we can press Shift-Control-Enter and get our chi-squared stat of 2.63 approximately. How significant is this chi-squared stat? Well, to do that, we have to apply the chi-squared right-tailed distribution, input the value of the chi-squared statistic as our x, and the number of the degrees of freedom would be the product of the number of rows minus 1 and the number of columns minus 1. Here we've got 2 states, 2 columns minus 1, times 2 states, 2 rows minus 1. So simple as that. So it will give us a 1 degree of freedom in the end. So we enforce this formula and we can see that our p-value is 10.51%, which is alarmingly low, but not low enough to reject the null hypothesis of efficiency, to reject the null hypothesis that the market is indeed efficient and that the transitions from one state into the other are random. But what will we see when we increase the number of states we consider? Well, to easily apply it for more and more examples, we can copy this formula, paste it into that cell, drag the respective arrays to the column that corresponds to the number of states equal to 3, and drag these cells to the ones corresponding to a particular identifiers of a state, given this example. And we can enforce this formula again, drag it across and down, and get our observed occurrences of transitions from one state into the other. And here, given the fact how smartly we applied this average formula, we can just copy this formula across without tweaking anything and drag it throughout the whole table. And again, we can apply the chi-squared stat, subtracting the expected occurrences from the observed occurrences, square this difference and divide it by the matrix of the expected occurrences. Close the parentheses and enforce this formula using Shift-Control-Enter and get a quite higher chi-squared stat of 9.4. But bear in mind that we have also increased the number of our degrees of freedom, as we consider 3 states instead of 2 states. So all other things held equal, we would have expected our chi-squared stat to be higher, even though the deviation might have been perfectly random. So now we have to apply the chi-squared right tail distribution again, input our new chi-squared stat as the x value and the new number of the degrees of freedom. That would be the total number of columns minus 1 times the total number of rows minus 1. And we enforce this formula and get 5.18%, which is lower than 10%, so we can say that this deviation from market efficiency, this deviation from randomness of transition probabilities is significant at 10%, but not significant enough to be significant at 5%. But it's indeed alarming. We can already see that given 3 transition states, we can already pinpoint some notable deviations from perfect randomness. But what would happen if our number of transition states would increase further to 4? Well, we already know what to do. We can copy this formula over here, drag the arrays to the new column, drag these cells down, apply the formula, drag it across, and drag it down. And we see that, quite naturally, the number of observations in each of these cells decreases further and further as we increase the number of states. And that's the ultimate limit of the Markov chains test, because for the chi-squared test to be powerful enough, you need to have at least 30 observations in each of your cells, because chi-squared test behaves very badly in small samples. So you can increase your number of states quite far down the line, but bear in mind that if you start encountering values lower than 30 in your cells, your test stops being that reliable. But here we can also apply the formula for the averages, for the expected occurrences, drag them across the table, and apply the well-known formula for the chi-squared stat: observed minus expected squared divided by expected, and enforcing it using Chisquared answer. And we've got a chi-squared stat that's yet greater still, and converting it into a p-value using the appropriate number of the degrees of freedom, number of columns minus 1 times the number of rows minus 1, we get a p-value of 5.5%, which is, again, close to what we've obtained in the previous example, but a little bit higher. So here we can reasonably assume that we would not actually spot anything more significant than 5% if we further increase the number of states, and given the fact that our number of observations in each of the cells approximately comes alarmingly close to 30, we can stop our testing here. But if you have larger samples, you can proceed with the test in the similar fashion to 5, 6, or even more states. And that's what's beautiful about it, the flexibility and the nature of the test, that you can test for a multiple number of ways that the market can be inefficient. That is what differs it from runs test or variance ratio test again. But now, and that's arguably what is the most exciting about Markov chains test, is that we can look closely at those transitions occurrences and formulate some plausible strategies that could exploit the inefficiencies we have spotted, at least at the significance level of 10%. First, let's consider the example with 3 transition states. For this example, we can see that the most striking occurrence is that it is much more likely to get a 3, so a very high return, after you got a very low return in the start. So actually, this transition matrix tells us, well, it's probably good to invest in the market when it just went down by a lot. When the past transition state is 1, it's likely that the next transition state would be 3. So you will gain if you invest at that point. And let's just test that. Let's consider that we are a very cautious investor and we only want to invest when we are more likely to gain. And let's do just that. So here we see that we have to invest, or we are better off investing, when the past state was equal to 1. And we are doing it in the example with 3 states. So let's apply this strategy simulation. So let's think about what our strategy implies. Our strategy implies that if the past state is 1, so if the stock market fell by a lot in the previous day, we are likely to get a high return in the next day, so we would invest. So it means that in the next day we would obtain the return of the market. If, on the other hand, we get states of 2 or 3 in the past day, there are no notable patterns that are beneficial for us. Well, if the state was 2, it's quite a bit less likely that you get a high return, so it kind of disadvantages us. And if the state number is 3, we can see that the probabilities are even more even, so you are not getting anything in terms of the gain over the market. So in that case, the investor can just stay in cash and obtain a secure return of 0 at that particular day. So let's apply this strategy all the way down for all of our trading days and see how well did it perform. To do that, we can just compare the return of our strategy and the risk of our strategy to that of the market, to that of the S&P 500 index. To calculate the annualized return of the market, we can, as usual, apply the product 1 plus function and applying it to the whole area of market returns. And given the fact that we've got 5 years worth of data, we have to raise it to the power 1/5 and subtract 1 to get the return and not the rate of appreciation. And enforce this formula using Shift Control Enter, we get that the average return of the market annualized during that period was 9.42%, which is pretty typical of US stock market. For annualized risk, we can apply the sample standard deviation function and apply it again to the whole array, and to annualize it, we can multiply it by the square root of 252. And we can see that the market provides us with an average annualized return of 9.42%, subject to risk of 13.4%. But what about our strategy? Let's apply the same formula, product 1 plus, to the area of our strategy returns. That will include zeros when we didn't invest because we believed in our Markov chain strategy, and equal to the market return when we believe that investing is beneficial and we're likely to obtain a high return. So here we just do the same thing and raise it to the power 1/5 and subtract 1. And we see that we have attained a little bit lower return than that of the market. But bear in mind, we have devised the strategy for a cautious investor, but maybe there are some gains in terms of the risk we're exposed to. Let's test that. Let's calculate the standard deviation of the returns of our strategy and multiply it by the square root of 252. And we can see that indeed we have reduced our risk quite a lot, from 13.4% to 9.4%, and we have sacrificed only a little bit of return for obtaining this particular gain in terms of risk. So for some risk-averse investor, such a strategy could be profitable, obviously if you can trade at reasonably low trading costs. But we have got another potential candidate for a profitable strategy. If we look at the example with 4 states, we can see that here the case that the market is more likely to go up by a lot after it fell by a lot is even more prominent. You are much more likely to transition from state 1 into state 4 than all other 3 states. So we can apply this logic and simulate another strategy by just tweaking it a little bit and referring to a different column. If our state number in the previous day was equal to 1 when we have 4 states, invest, and don't invest and stay in cash if your state number is anything but 1, because we can see here that there are no potential gains that are as high as for the state number of 1 if we are currently at states 2, 3, or 4. So the logic actually kind of persists from the previous example. Let's see what this strategy delivers. Let's enforce this formula and bottom like it all the way down, and all the formulas would be recalculated automatically. And we can see here that this strategy delivers even lower return, but it also reduces risk. But the reduction of return from 7 to 5% is quite material. It's comparable to the decrease in return we have experienced when opting for the Markov chain strategy with number of states equal to 3. But the reduction of risk is not that material, from 9.4 to 8.65. And it kind of corresponds to the fact that in those 2 cases, we do not gain anything in terms of the p-value. By increasing our number of states from 3 to 4, we do not spot any further inefficiencies in the market that we have already spotted with the model where we consider 3 states. So, are Markov chain strategies useful? Is the Markov chains test applicable? Yes, but partially. You can use Markov chains test to detect notable market inefficiencies, and it can be applied to a wider number of cases than the runs test, or even arguably the variance ratio test, because you can consider various numbers of states. But for developing of trading strategies, it can be useful only to risk-averse investors, and only if you correctly specify your model and select an appropriate number of states that give you the most significant inefficiency of them all. And that's all there is for the Markov chains test and trading strategies developed based on it. Please leave a like under this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, economics, or finance you would like me to record. And please don't forget to subscribe to our channel or support us on Patreon. Thank you very much, and stay tuned.